Hello, everyone. My name is Liz Holohan, and I am the Programs Director at Alumni Affairs. On behalf of UC Santa Barbara alumni, I want to thank you all for joining us this evening for the November edition of Gaucho Academy, presented by American Pacific Mortgage. And this webinar series features keynote speakers and expert panelists who delve into topics pertinent to our Gaucho community. And I'm delighted to introduce Jason Matta, who will be leading tonight's home buying workshop. Without further ado, over to you, Jason.
Thanks, Liz. Appreciate it. And thank you so much for joining us on this Thursday evening. We have a great group here, very well attended. I appreciate everyone taking time out of their busy schedules to be a part of this class. This is a very interactive class that we do. We usually have these classes available to UCSB alum once a quarter. So, if you enjoy tonight's presentation, we'd love for you to kind of share this with friends, family, maybe even some colleagues that might enjoy this topic around homeownership. And I think it's an opportune time to have this conversation. Obviously, a lot going on these days, and I think understanding financially what homeownership can look like for you is a great first step. So, a little bit about our organization. We're very pleased to be a partner with the UCSB Alumni Association. I work for an organization called American Pacific Mortgage. We're a California-based direct lender, but we service all communities across the country. And our team in particular specializes in providing resources around first-time home buying through educational platforms like our workshop series. Again, my name is Jason, and I'm obviously going to be your facilitator this evening, but I also get a chance to work with our clients one-on-one on designing home buying plans for them to help them on that path towards homeownership. So my specialty is kind of more around first-time home buying and providing education around that journey towards homeownership. Well, tonight's class is very interactive, and as we go through tonight's class, we'd encourage you to ask questions. You can use the Q&A function in Zoom, and myself and my colleague Ken, who will be helping me kind of walk through or kind of manage the Q&A. We'll take those questions on air. I'll answer those, but we'll also carve out a little bit of time just before the end of tonight's class. Now, the runtime for class is just about an hour, so we should have you out of here just before the top of the hour. And so here's kind of what we're going to talk about tonight. We're going to spend some time looking at the housing market in just a little bit. We're going to kind of examine what are some trends in the housing market, talk a little bit about interest rates, which tends to be one of our hot topics, if you will, in these classes. We'll also talk a little bit about budgeting for homeownership. And we're going to do a little bit of a comparison of continuing to go down that path of renting versus what could it look like if I decide to purchase a home. We'll also spend some time looking at credit. How can I have my credit in the best possible position for home buying? For those of us that are going through repayments on student loans, we'll talk about what that does from a qualifying perspective. We'll also look at loan programs, documentation generally needed as I start this journey on home ownership. And then we'll also look at some first-time home buyer programs that could help support you as another resource in home ownership, and talk a little bit about how do I start savings for home ownership. And then finally, I want to kind of walk you through the workflow of buying a house. So after tonight's class, you may say, hey, I want to get connected with you to kind of learn a little bit more about designing my own home buying plan. Well, we'll get a chance to show you what those next steps look like. All right, so let's go ahead and dive in. And, when we think about home ownership, it's probably going to be one of the biggest financial decisions we decide to make, right? And so the fact that, many of you in tonight's class are taking time out of your busy schedules on a Thursday evening to learn a little bit more, obviously you can see the importance of, doing your research, but understanding what this all is about in home ownership. It's, again, probably going to be one of the biggest financial decisions we decide to make. At the same time, there's a lot of great benefits that come along with owning a home that we want to factor into the equation. For example, this can create affordability for ourselves from the perspective of I'm not, looking at my rent going up each year that I decide to renew my lease. I can create better affordability based upon the purchase price I'm going to pay for, how much I decide to put down on my house, and my payment should generally be a fixed payment on that house. The home should be a potential asset for you. That asset can appreciate over time. So as I see my home grow in value, I pay down my balance. The difference in value versus balance is home equity. For most of us, that's probably going to be one of the biggest assets that we own. And that asset is such a large portion of our overall portfolio, is it probably is going to create generational wealth for our family. Now, there's also some really good tax benefits that come along with owning a home. So when we think about home ownership and we kind of plug all these benefits in, I would say it's not really an apples to apples comparison when you look at renting versus buying. And to illustrate that point, we always like to kind of launch into our classes looking at a budgeting exercise. So as a future home buyer, we can do a quick comparison of what does it look like if I continue to rent for the next 7 years? But what if I decide to purchase over the next 7 years? Where's my opportunity in that comparison? So let's kind of do a quick switch of screens. I'm going to take you to a budgeting calculator. And this calculator is brought to us by Freddie Mac. You're going to learn a little about Freddie Mac as well as Fannie Mae a little bit in tonight's class. They kind of have oversight of about 60 to 70% of all originations across the country. So these tools can be found on their website. By the way, as a side note, all of our presentation material from tonight, we're going to send back out to you tomorrow morning. We're also recording tonight's class. So, if you do want to share this with others, we're going to have this up on our YouTube channel tomorrow as well. So, you can have access to all these resources. Well, here's the way this calculator works. So again, it's a rent versus buying calculator, and it's broken down by a rental side versus a buying side, right? So if we look at it from a rental perspective, and of course, these numbers will vary based upon where you're at in the country, whether you're in Orange County, Ventura County, Sacramento County, the Bay Area, whatever the case may be, those numbers may change. But I would encourage our audience, take some time to use these calculators to see what this could look like for your own particular scenario. But in our example here, let's assume that I'm paying rent of about $3,000. I have monthly renter's insurance at around $15. Then I'm going to expect my rent to potentially increase about 5% on an annual basis. All right, so that's my rental side of things. And then on the home purchase side, we're going to assume that we're going to buy a $750,000 home, that the down payment for that house, which we're going to learn more about programs in just a bit, is 3% of that purchase price. We also factor in property taxes for a home. For most scenarios, we're going to calculate property taxes at 1.2 to 1.25% of that total sales price. Then we have homeowners insurance, and then we also want to factor in the cost of maintaining my house on an annual basis. All right, so that's going to be in our home ownership column. And then we also want to factor in what's the financing look like for this home that I'm going to purchase. Well, it's generally going to be a 30-year fixed mortgage. We have an average interest rate of right around 6.75%. We're going to talk about interest rates in just a little bit. And then we have origination charges. So when we think about origination charges, those are part of closing costs to buy your home. Now, closing costs are going to be lender charges, title and escrow fees, some of the charges for the county that you're going to purchase in. We generally recommend buyers to budget about 2 to 3% for those total expenses in purchasing a home. Now, from a lender perspective, one of our benefits for the UCSB alum is that we actually discount our services by $750 on the lending side. So we try to make things a little less expensive for you in this home ownership design. Now, there's another section here called discount points for buyers that are choosing to purchase the home, but need to maybe achieve a little bit of a lower monthly budget because they need to bring down their interest rate. A buyer can pay discount points, and discount points are generally 1% of your loan amount. And that equates to out-of-pocket expenses that hopefully will bring down that interest rate. So let's say, for example, I have a $700,000 loan, but I'm paying one discount point. That means my expense is $7,000 in cost. That generally will equate to about a 0.25% reduction in interest rate. And then we have other settlement services. Those are kind of fall under that category of closing costs. Those could be title and escrow fees, could be some of the fees charged for the county that I'm going to buy in. And then we have other assumptions that we want to consider. As we mentioned earlier, we're going to assume that we're going to be in the home for 7 years. We have an appreciation rate that we're going to project out at about 4%. We have state and federal tax rate roughly at 33.8, and then finally a savings rate of 3%. So those are kind of all the inputs that go in this calculator. Again, I would encourage you to kind of do your own calculation based upon your desires for where you want to purchase, maybe where I'm currently at from a rental perspective. But in our example here, if we have a scenario where I'm paying $3,000 in rent, I compare that to buying. Now, keep in mind, buying, we're going to almost have to double our housing output. So that takes us to about $6,300 a month in outgoing expense from a housing standpoint. But if I was to look at my total cost opportunity over the next 7 years of renting versus buying, I have about a $56,000 opportunity of owning my home over the course of 7 years versus continuing to rent. Now, how did I achieve that number? Couple areas. One is we're expecting our home to appreciate over the course of those 7 years, which in turn gives me more equity at sale or more proceeds available at sale. Secondly, we also factor in tax benefits that come along with owning a home. Now, everybody's scenario is going to look a little bit different, whether I'm paying a lower amount of rent or I'm purchasing a higher home or a lesser priced home. But I would encourage you to kind of run through that math yourself and as you're kind of thinking more towards home ownership. All right, so that's our rent versus buying calculator. Let's talk a little bit about the housing market. Lots going on in the housing market. Now, from a seasonal perspective, we're obviously in the winter months now. So generally we would see the housing market start to slow down right now, whether you're in, Santa Barbara or LA or up in the Bay Area markets or anywhere in the rest of the parts of the country. Even though, temperatures are changing a little bit, buyer demand has kind of heated up, honestly. Now, traditionally, we see buyer demand start to pick up around April or May. Well, guess what? This year in 2024, a little bit different. I think a lot of what kind of maybe pushed buyers to the sidelines was the level of interest rates, kind of what's going on economically. And so, April and May, while it's traditionally busier months for home buyers, it really kind of slowed down. In fact, we didn't see buying habits pick up until July or August, and it's kind of really continued since that point. Much of it, I think, is around the consumer mindset that really the interest rates were at higher levels earlier in the year, but in July and August, we saw a little bit of a decrease in rates. But I think the average consumer, how they're thinking about home ownership is that interest rates aren't going to change much. And so we saw a lot more buyers diving back into the markets, which kind of picked up the demand. At the same time, we really haven't seen a lot of supply that's entered the market. So when we think about supply, we're talking about existing homeowners that are choosing to sell their home because maybe they're downsizing, upsizing, maybe completely getting out of the market. We haven't seen that type of inventory. And the reason why that is because most of our existing homeowners probably refinanced at 2.5% to 3% rates back in 2021 when rates were at all-time lows. And so it does put some challenges in the supply that's available to buyers. But we are starting to see buyer demand pick up even more, even under the constraints of today's interest rate and economic environment. Now, here's kind of a look at what the general California housing market's done. Now, the median sales price, obviously, was quite high in California, but we're seeing prices kind of level a little bit, which at times you would think, wow, with today's interest rate market, prices are coming down, but we've seen a little bit of a leveling. The question we get from prospective buyers is, what's this market going to look like as we kind of forecast into the future? What's going to happen now, right? And I think as we look at the interest rate market, that's going to really drive a lot of what's going to go on in the housing market. So generally speaking, as interest rates go down, we're going to see buyer demand pick up even more. The challenge is going to be the amount of supply, right? So if we have limited supply, but we have high demand, that's going to probably push prices up a little bit, especially as we get into more of kind of the traditional seasonal months that we see in buying, the April and the Mays. Now, what we see on screen here is kind of a look at interest rates over the last 12 months. This has been kind of a wild ride, unfortunately, for us. So if we were going to go back to October of 2023, rates hit almost 8%. It was a very difficult time. Affordability was at all-time lows. And you can see kind of as we entered into Q1, we start to see rates start to drop, thank goodness. And so we've been on this kind of choppy path. Then we saw interest rates 5 weeks ago drop, which was one of our basically our 12-month lows in interest rates. Everything looked really positive. That was spurred by the Federal Reserve cutting rates 0.5%. Well, unfortunately, we've had some positive economic indicators come out, namely the job markets, which kind of switched the markets around a little bit. And then we see this kind of steady increase of the 30-year fixed rate over the last 5 weeks. Now, we believe that interest rates have kind of like maybe made a turn a little bit. All that being said, obviously we've had 2 major events this week with the elections just a few days ago, as well as today, the Federal Reserve made another announcement of another rate cut of 0.25%. That 0.25% cut will impact interest rates, kind of a more of a ripple effect. It's not necessarily a direct correlation to mortgage rates, but we will see interest rates start to drift lower. Obviously, some of it will be dependent on what monetary policy looks like in 2025. But the Federal Reserve has mandates on, where they need to get our U.S. economy to. A lot of what we're dealing with right now in elevated interest rates is a product of higher inflation that we're dealing with. And you and I feel it, right? We feel it in the cost of gas, the cost of food, services in general, right? Inflation has been a challenge for all of us. The federal mandate for the Reserve is for them to get to 2% inflation. And right now we're at about 2.6, but as inflation levels continue to decrease, then we'll continue to see interest rates go lower. Looking into 2025, we're going to see probably 4 rate cuts by the Federal Reserve as we wind into 2025. Obviously, we got a rate cut today. I think it's just important as we kind of move through interest rates. When you think about the Federal Reserve cutting rates, it's not necessarily, again, not going to be correlating directly to mortgage rates, but where you will see it correlate is to credit card rates. You'll see it around personal loan rates, some of the auto financing that's out there. Now, from a mortgage perspective, interest rates are not the same for all products or all buyers that are looking to purchase. There's different characteristics that go into interest rate, like credit eligibility, the product that I'm going to select, what my amount financed might look like, how much my down payment is going to be. We talked a little bit earlier about discount points. So if I'm deciding to pay additional funds out of pocket to bring down that interest rate, that can obviously influence that interest rate. And then finally, the term of my loan can also change my interest rate. Generally, in normal markets, if I shrink that term of my loan from 30 years down to, say, 20 or maybe 15 years, that should lower my rate. Currently, in today's market, where short-term rates are essentially on line with long-term rates, we don't get a lot of benefit in terms of shortening the term. But most of our first-time buyers are going to elect a 30-year fixed-term product. Now, as we get a chance to meet with clients, we're going to figure out what the right fit is for you with term, interest rate, product selection. And so that's kind of part of our home buying plan that we create for our first-time home buyers. Now, we're going to talk a little bit about credit. And when I think about home ownership for our future buyers, there's usually kind of 2 challenges to home ownership. One could be maybe I haven't saved enough money for home ownership, and we're going to kind of explore that a little bit more in tonight's class. But the other side of it could be maybe I'm a little bit overextended in my credit. Maybe I'm just getting started with credit, or maybe I just need to manage my budget a little bit better on the credit side. So, those are kind of 2 of the things that are usually hurdles for first-time buyers, but certainly not something we can't overcome. And I think it's important to first understand what credit might look like. Now, there's a lot of great monitoring tools that are available to us, whether you're using Credit Karma or some of the credit agency products. But within those agency products, there are different credit risk models. So there's a credit card model that most of you guys are going to see show up in your credit monitoring tools that you use. There's also an auto financing model, risk model. And then finally is a mortgage model. So of course, when you're doing home financing, we're going to be using the mortgage model when it comes to the factors that go into the score calculation. So it kind of looks like this, and you can see that on screen here. 15% of my credit profile is going to be based upon how long have I had credit. So the longer or more mature my credit file is, the higher my credit score is going to be. 20% is going to be how much new credit am I trying to access? Am I trying to open up new accounts? Am I having a lot of new inquiries on my credit? Those are going to impact my score by 20%. For example, today I had a client I met with earlier this morning, and her credit profile, she had 6 newly opened accounts in the most recent 12 months. Now, while her payments were on time, because we had 6 accounts opened in a short amount of time, the credit model is trying to see if my client can actually handle that level of debt in such a short period of time. So in that example, that's where that 20% factor would come into play. Significant amount of accounts opened up in the most recent 12 months. So we kind of really want to limit activity in new accounts, because in turn, if we do have too many accounts open, we'll see that credit score start to pull back. Now, one of the things we do in building home buying plans for our clients, we only start with a soft credit check. And the reason why we do that is because for many of our first-time buyers, that journey towards homeownership is not going to be a quick turnaround. It could take several months, maybe even 2 or 3 years. So we want to always start with a soft credit check, not to impact the credit score, because hard inquiries will impact a borrower's credit score. 30% is going to be centered around revolving accounts. So we're looking at credit cards, personal lines of credit, and we're looking at the credit limit on those accounts versus the credit balances. That's called credit utilization. So we're trying to see how much am I using of that credit limits that are available to me. Now, ideally, we want those balances to be at 10% or less compared to my credit limits. If I have maybe overextended credit right now, maybe I'm at 80% utilization. I really want to work towards getting those balances below 50% utilization of those credit limits. Now, let me give you a quick tip to kind of consider in managing credit debt. So if you were to take some time to look at one of your credit card statements, there's two important dates on those statements. One is the statement date. And here's what the statement date means. It's the date at which the credit card issuer is closing out all the activity on your credit card. But it also is the date that they're sending out all your payment information, account information to the credit agencies. So when that closes out, all the data gets reported out. The other date is your due date, right? And that's, of course, when you make your payments. Here's what I would encourage you to do. If you're trying to maximize your credit score, try to pay down your balances or pay them off before the end of the statement date, because then that's going to allow you to get lower utilization reporting, of course, on-time reporting, and then, of course, lift your credit score. All right, so that's one of our tips around utilization. Last component to the credit score is pretty simple. It's payment history. How have I paid my bills? Those late payments, if any, will be rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. If I've had a late payment in the past 12 to 24 months, that's going to be the most impactful to my credit score. If I've kind of reached beyond that, maybe it was 5 years ago that I had a late payment, then that shouldn't be as impactful because they're kind of seasoning off of your credit report. Now, every product has a minimum credit score. You can see those on screen. Each credit agency is going to give us a credit score. So TransUnion, Experian, Equifax, all different risk models, all different credit scores that come back to us. From a lending perspective, we always take the middle score of all three agency scores. So here's an example. Let's say I have a 760 as my top score, 740 is my middle score, and then 720 is my lowest score. Well, from a financing perspective, as a lender, I'm going to take the 740 score, which will impact my product eligibility, can also impact my interest rate. And then we're going to talk more about mortgage insurance a little bit, which it can also impact that as well. Now, let's say, for example, I have a partner that also wants to join me on the application, but that partner scores are slightly lower than mine. So let's say my partner's at 740, 720, and then 700. Well, my partner scores are 20 points lower. That could change what my financing looks like because we always take the lowest middle score between both borrowers. So in that case, the lowest score is 720. Last thing I want to kind of touch on in this section is looking at account history and as it relates to revolving accounts. And so if you're in the habit of doing balance transfers and maybe closing out your old account, just be careful before you close out that account because at times that can damage your credit score because when you close out a credit account, like let's say a Visa card that you no longer use, when you do that, it pulls away the history of that account from the credit bureaus. It also takes away another credit limit that you have available to you for the utilization of credit. So just be careful of that because that can actually hurt your score a bit. Now, if you've had some past challenges around credit, here's kind of a matrix that will show you how long those items will stay with you on your credit report. But it's important to understand the event in the most recent 12 to 24 months is the impact to the score. This is just how long the impression will be, so to speak, on the credit report. All right. Well, we're going to talk about student loans now, but before I do, I just want to just open up to the audience. I know we don't have any questions in the Q&A so far, but I just want to let the audience know. If you do have any questions, just drop them in the Q&A. We'll answer those live on air. And then, of course, later on in tonight's class, I'll go ahead and go through any questions that come up at the end of class. All right. All right, let's talk a little bit about student loans. And those come up in the conversations with clients as I get a chance to meet with them to design their home buying plans. Now, some of you might be in a student loan forgiveness program. Great. Some of you might have a forgiveness program as being a public employee. And some of us might have forbearance status right now, or maybe even deferment. Now, regardless of one of those statuses, unless the student loans are completely forgiven, we have to count a minimum payment into qualifying for home financing. So let's say, for example, I have an income-based repayment program and I have $75,000 worth of student loan debt. If my income-based repayment amount is 250, well, that's what I can use to qualify for my home financing. But let's say I'm back in school and I'm working on my master's program, right? And my student loans are in deferment. Well, if I'm not actively repaying, then as a lender, we're going to have to either qualify with an active new repayment schedule, or by default, if we're doing a conventional loan, that same $75,000 in debt, we'd have to look at 1% of the balances as the monthly payment. Or if we're doing an FHA loan, we would take 0.5% of those balances as the monthly payment. So that's important to consider when we're looking at financing for you. I mean, student loans generally come up in, I would say, 1 to 2 of my consultations per day. I mean, it's a conversation that we're going to have, but it's not insurmountable to be able to get through student loan debt when it comes to qualifying for home financing. But I think it's important to understand that there's some confusion around if you're in forbearance or deferment. Even if you're not making monthly payments, we do have to factor a payment into qualifying. Okay. There's a question that came in actually through the chat. Let me just take that, and then we're going to kind of talk a little bit about loan programs. The question was, what is the optimal number of credit cards to possess, and what kind of credit cards have the biggest impact on credit scores, bank cards, travel cards, shopping merchants, so on and so forth. So the type of credit card doesn't impact your credit score at all. Types of accounts on your credit report can. For example, personal loans, like through whatever personal loan provider you want to name, can hurt your credit score, especially like online personal loan companies. So that can change, but different credit card companies, whether it's an Amex or a Capital One, does not going to change anything. I get the question a lot of what's the optimal level. It's really hard to call it. I would say in my own personal situation, I like to keep only 3 credit cards. I think it's just easy to manage, and obviously try to keep the balances as low as possible. Try to pay those off monthly and just charge what you can pay. But everybody's situation is a little bit different. I think as you start getting beyond 3, that seems like a lot to manage from my perspective. So you just want to be careful. And of course, annual fees start to stack up on credit cards too. So you want to be mindful of that as well. All right, thanks for the question. Let's talk a little bit about loan programs. And so we'd like to kind of give you a high-level look at loan programs and what they might look like for you as a first-time buyer. We're going to spotlight 5 programs here, of which most are going to be around the conventional and FHA product, but there's a lot of different options available to you as a first-time buyer. So let's kind of dive into each one of those. So a conventional loan is going to be labeled under Fannie Mae and Freddie Mac. So you heard me mention Freddie Mac earlier in our budgeting session. With a Fannie Mae and Freddie Mac loan, that is a conventional loan product that allows us to finance up to 802,650, which is the conforming loan limit for 2025, this upcoming year. Now, in high cost of living markets, and guess what? If we're in Santa Barbara or we're in LA or Orange County, we're in high cost of living markets, we can take that loan amount, we can push it all the way up to 1.149 million, but the minimum down payment moves from 3% up to 5%. Okay, that's called a high balance loan limit. The conventional product has a minimum credit score of 620, and that space in the originations of financing really is about 60 to 70% of all originations across the country. Now, the conventional loan, as compared to, say, the FHA loan, doesn't have as much flexibility from a guidelines perspective. We're really looking at on-time payment history, especially in the most recent 12 to 24 months. Whereas we look at the FHA product, that's going to have a little bit more flexibility for our buyers. Now, FHA stands for the Federal Housing Administration, so that is a government-backed loan. And so that also carries with it a different dynamic from a mortgage insurance perspective. FHA loans can go up to 805, but they can also stretch up to that same $1.149 million loan amount in high cost of living areas. Minimum down payment on an FHA loan is always set at 3.5%. Regardless if I put 3.5% down or 20% down on an FHA loan, I still will have mortgage insurance, which we're going to spend some time talking about in just a bit. The minimum credit score on an FHA loan is 580. And again, as we compare FHA to conventional loans, a little bit more flexibility from a qualifying perspective. Next product is our VA home loan. That's for our veterans that have eligibility on the VA product. Just a wonderful product to support and provide resources for our veterans. A lot more flexibility from an underwriting perspective, lower credit score requirements at a 620 credit score. One of the great benefits about the VA home loan is a veteran can put no money down to purchase a home. And right now in the guidelines, there really isn't a cap on maximum loan amount, even with that zero down payment option. Next product is a USDA loan. Those are for clients that want to buy in more rural areas that fit the criteria of USDA. There's two big qualifiers for USDA. One is the kind of the location of the property has to be on the map for USDA's eligibility. And there's also income requirements by household size. And the last product we just like to share with our audience, not typically used for first-time buyers, but it's called a jumbo loan. And those are for clients that need a little more financing that stretches beyond some of the agency products. It is going to have a higher level of down payment, usually 10 to 15% down. There's additional asset requirements on jumbo loans. So in addition to maybe me saving up for my down payment plus my closing costs, I'll also need funds for what we call is reserves. And reserves are usually the equivalent of 12 months of my monthly payment that I need to have kind of left behind after I've contributed those down payment and the closing costs. Well, in connecting with clients and designing their home buying plans, inevitably the conversation centers around private mortgage insurance because most of our clients are, especially as first-time buyers, we're just trying to get enough money together to put the minimum down payment for purchasing a home, right? And so I think it's important to understand what's the impact to us as a consumer if I'm putting less than 20% down. Now, there's different ways to look at mortgage insurance, and we're going to kind of explain that now. There's PMI, which stands for private mortgage insurance. Then there's on the FHA side, government-backed insurance. Now, PMI, whether it's conventional or FHA, essentially insures a lender against default by a buyer. And on the conventional side of things, there are different ways or payment options for PMI. So the one is you can pay it monthly in your payment, which 90% of most buyers will do. You can split that mortgage insurance up, pay some of it up front, some of it monthly. You can also pay out the full mortgage insurance up front. You can also take an elevated interest rate to buy out your mortgage insurance. So those are some of the payment options that are available. And PMI is not the same for all clients. There's different characteristics that go into the premium of the PMI. One is down payment, the other is credit score, and the third is amount financed. So if some of you in class tonight have already been on Zillow or Redfin, and maybe you're kind of looking at your options in your neighborhoods or places that you would consider buying, if you use one of their calculators, it's not going to be calibrated to how I've described it here to you tonight. So you might see maybe a mortgage insurance that's like $300 a month, but in reality, it's maybe $150 a month. To that point, let's take a look at an example of a conventional product. So if you were to purchase, and let's say you financed $700,000 and you decided to put 3% down and you had a credit score right around 740, the mortgage insurance is about $209 per month. Now, the more I can elevate that down payment, or the higher my credit score is, that'll help bring my mortgage insurance premium down. One other thing to touch on the conventional PMI is that it does have a cancellation option that once I have 2 years in my loan and 20 to 22% equity, I can apply to have mortgage insurance completely canceled. Now, on the other side of the equation is the FHA loan product. Now, that's a government insured product. It does not have a cancellation option as opposed to the conventional loan. We look at the FHA loan as kind of really an opportunity to get into home ownership, but it's probably not going to be the long-term solution for most of our buyers. And when we look at the PMI structure, it looks like this. So my monthly PMI is 0.55% of my total loan amount, and then we divide that by 12. That's how we come up with the dollar figure. There's also upfront mortgage insurance, which is the equivalent of 1.75% of my total loan amount. So if we looked at the example of PMI for the FHA side, let's say I have that same $700,000 amount financed. Now I have to add on my upfront mortgage insurance, which in this case would be $12,250 plus, and by the way, that's a one-time expense. But then we also have monthly mortgage insurance ongoing, which would be $320.83. So obviously the expense structure looks a lot different between the conventional and the FHA product. The question we get from our clients and our attendees in our classes is, well, why would I ever choose FHA over conventional? Well, it just depends. Everybody's situation's a little bit different. I may have a late payment back in October of last year that's impeding me from getting access to a conventional loan because maybe that late payment's kind of tripping things up, and FHA might be a better solution, or maybe I have a lower credit score requirement. But different products have different guidelines. And so as we get a chance to meet with our clients, we're going to figure out what the best match is for you. Now, under those guidelines of the products, there's always income qualifying requirements. Now, part of those qualifying includes documentation that we have to gather and validate. That generally includes the last 2 years of W-2s, usually last 30 to 60 days of pay stubs. And then from an asset perspective, we usually need the last 60 days of whatever asset accounts we're going to incorporate into our application. Now, from an income perspective, we have to kind of examine employment history. Now, we have to look at the last 2 years of employment and or education history. So what that means is we have to show that we've established education. Let's say I went to UCSB for 4 years undergrad, and now I'm starting my job. Now, since I have my educational history, let's say I graduated back, let's say in spring of 24, right? And now I just started my job in October. Because I have 4 years of education, even though I've just started my job, that educational history will actually count towards my 2 year of employment education history that's required under financing. All right. Now, I can even have a situation where I'm having to, or maybe I'm switching jobs, right? Let's say I'm going to start a new job on December 1st, but I've only been at my previous job for 6 months. You can still have eligibility for financing. The rule essentially on 2 years is just being able to show that 2 year work and or educational history. Now, where it gets a little bit more challenging on that 2 year rule is to be able to show that if I have like multiple sources of employment. Let's say I'm in, we see this sometimes in LA County, some of our clients that are in the entertainment industry, right? So maybe I'm working for one studio here for 20 hours a week. Maybe I'm working for another studio for 30 hours a week. In that scenario, if I want to count both sources of income, then I do have to show that I've been working for both studios simultaneously for the last 2 years. Okay. If I'm self-employed, I have to show that I've been self-employed and filed taxes for a full 2 years. So that's where that 2 year requirement will come into play. Last thing I would say as it relates to employment is that if I'm starting a new job, so let's say I'm going to start that new job on December 1st, we can potentially qualify clients with an offer letter for prospective employment. They don't necessarily have to start their job or be there on a certain amount of time. The only caveat to that would be if I have a compensation plan that's heavily leveraged on commissions or overtime or any type of incentive plans. In that case, I do have to show a 2 year history with that employer. All right. And last thing, just to leave you with, is that when I have an additional source of income, let's say my partner is contributing to the household budget, but my partner is not going to be part of the application. In that case, unless my partner is going to join my application, then I can't count that income source for qualifying. Now, as a lender, we look at our expenses versus our income. We call that an expense ratio or a debt to income ratio analysis. And what we're looking at is our pre-tax income versus our outgoing expenses. And those expenses include things like personal loans, credit cards, auto loans, and whatnot. We don't want those expenses to exceed more than 43 to 45% of the pre-tax income. Now, there are exceptions to go up as high as 50% in total expenses, but generally we want to keep that to that 43 to 45% range. And this is what the calculation looks like. We have the principal and interest of the mortgage that I'm taking out, right? The property taxes of the new house that I'm purchasing, as well as the homeowner's insurance. And if I'm putting less than 20% down or I'm doing an FHA loan, I'm going to have mortgage insurance. And if I'm buying a condo, maybe a townhouse, or maybe a home that's in maybe a planned community, I might have homeowners association dues. Let's say that total household expense is $2,500 a month, and then my other debts are like $500 a month. Well, right now I have $3,000 in expenses, and then my income is $8,500 a month. So in that case, my total expenses or my debt to income ratio is 35.29%. So essentially, my expenses are occupying 35% of that income. Now, the question I get from future buyers is, well, I understand the guidelines are 43 to 45% or maybe as high as 50%, but what's the comfort zone for most buyers? And I would say in working with hundreds of buyers across the country, it's usually around 33 to 36%. That's kind of the comfort zone. Now, that does change based upon how we can document your income, or you may have other sources of income that we can't necessarily validate. So it does vary a bit. Now, the most important thing to me is, in we designing plans, is two kind of real big goals for us. It's affordability and it's sustainability, which basically means we want to create an affordable home buying design for you. And we want to make sure it's sustainable over time. So if things change financially for you, you can still handle your mortgage payment. So while debt to income ratio is helpful, it's certainly it's going to be looking at more from a guidelines perspective, not necessarily affordability. All right, the last thing we want to kind of touch on when we're kind of thinking about building a plan for homeownership is to think more about savings for homeownership and around more of the asset requirements. Now, we heard earlier that we have to save up for what our down payment as well as closing costs to purchase a home. And that those resources need to be documented. And that's usually done by verifying maybe cash accounts like checking and savings accounts. Retirement accounts can potentially be used like 401ks, 403bs, even IRAs. I always encourage clients to talk to your tax advisor before accessing those assets. You can also have family members that can contribute to the purchase of your home. We call those gift funds. There's a way that we document those funds. Generally, most assets have to be seasoned for at least 60 days. So they have to be in my account 60 days, but gift funds can be transferred over right away. So there's no kind of seasoning requirement around that. Now, as we talked earlier in our class, there's two big challenges typically to homeownership, right? So it could be around credit because maybe I'm just budgeting on some of my credit debts, or it can be around savings. So I want to talk a little bit about savings, and I want to kind of shift over to some assistance programs that are available to you. But I want to give you kind of a really simple discipline to put in place when it comes to savings. And we'll kind of go back to our example earlier in our budgeting exercise, which was someone that's spending $3,000 a month in rent, but can really afford about $6,000. So we know there's about a $3,000 surplus there from a housing budget perspective. So if I was to kind of change up things in how I save, and here's what I would do. So at the first of the month when I'm paying my rent payment, if I'm truly capable of paying up to $6,000 a month in rent, when I pay my landlord the rent payment, right, I have that $3,000 outgoing. Create the discipline for ourselves, that additional surplus I have of $3,000, that goes into my savings account on a monthly basis. And so as we kind of move through the year, let's say at the end of 6 months, I have an additional $18,000 in savings. Maybe I also get a tax refund that can also add surplus to that savings. By the end of the year, maybe I have an additional, 36,000 by the end of the year. That does two things for me. One is obviously it creates that savings or that nest egg for homeownership, but it also creates the discipline of that new payment for myself, because what we don't want to have happen is as we transition into homeownership, we don't want to have this massive payment that doesn't really feel affordable for us and not be prepared to take on that new expense. All right. So that's kind of our savings plan and kind of how we look at things in guiding our home buyers. Now, there are assistance programs that are available to you also as first-time buyers to make homeownership that much more of a near-term goal for you. Now, I know most of us are in California, so we're going to kind of spotlight CalHFA, which is the California Housing Finance Agency. We're proud to be the #1 partner with CalHFA serving our communities in homeownership. There's a few different programs that are available that I wanted to kind of share with you this evening. One of the programs, which is not on screen, that may come out again, and you may have heard about CalHFA through this program, was called Dream for All, which essentially allowed someone to get access to 20% of their purchase price in the form of a shared appreciation loan. That was a lottery-based program. Unfortunately, it's not available at this time, but you may see future news on that, so stay tuned for more details. But what is available through CalHFA are two different programs. One is called MyHome Assistance Program. The other one is called ZIP Assistance. Essentially, what MyHome does, it provides up to 3% of your sales price in assistance on a conventional loan, 3.5% on an FHA loan. And what this is, the state creates a separate loan for you at a 1% interest rate. And it's a simple interest loan that does not require repayment until you either sell the home or if you decide to refinance the property in the future. So really great tool to help cover that minimum down payment. Now, if I need additional resources, there's a program called ZIP, which essentially is a zero interest program. It's an add-on to the My Home Assistance Program. So I would first have to start with My Home, and if I need more resources, then ZIP would come into the equation. Now, right now in today's market, we're still at elevated interest rate levels. I don't necessarily recommend ZIP assistance because it can really move the number up quite a bit on interest rate. But certainly the My Home Assistance Program is a really great tool right now. As interest rates drift lower, the ZIP assistance program will probably be a little bit more appealing for buyers. If we were to look at a scenario of incorporating CalHFA into our home buying plan, it would look like this. So let's say I buy a home for $700,000. We learned earlier the minimum down payment is 3%. And then we have closing costs, which are anywhere between maybe 2 to 3% of that purchase price. So if I was not using an assistance program, I'm probably going to need about $35,000 to $42,000 out of pocket. Well, for most of us that attend classes like this, that's probably going to be a bit of a stretch for us to reach anytime soon. But if we incorporate something like a My Home Assistance Program, now we have that minimum down payment met of the $21,000. And maybe that homeownership goal seems a little bit more attainable because now I only have to worry about putting out of pocket maybe my closing costs, which could be anywhere between 14 to 21,000. And so those are resources that are available to you and therefore designed to help first-time buyers in California that are considered low to moderate income buyers. And believe it or not, a moderate income buyer in the state of California is someone that makes up to 150% of the median income. I'll share with you more about those income limits in just a few minutes, but this is kind of what the eligibility requirements look like for CalHFA. Minimum credit score of 640 for the FHA product, 680 for the conventional loan. We talked a little bit about debt to income ratio. You can see that on screen. One of the unique things about CalHFA is we look at applicant income, not necessarily household income. So if we're looking to try to stay below the income limits, and let's say I'm a dual income household, in some cases I can apply with just one income in order to stay within the income limits. So like, for example, in LA County, the maximum income is $194,000. Let's say I make $150,000 and my spouse makes $60,000 a year. Well, combined, we're over the income limit. But if I decide to apply just in my name, then potentially I could qualify just off of my income. Now, a first-time buyer is someone that hasn't owned in the last 3 years. So I may have owned a home back in 2010, since sold. As long as I've been renting for the last 3 years, I'm still considered a first-time buyer. And these products are eligible for basically one-unit properties, single-family homes, townhouses, condos, even manufactured homes, some of our rural markets. Here's the income limits for the CalHFA program, so you can check that out. Like I said earlier, LA County is 194, and you can see all some of the neighboring counties. If you're in a different market than Central Coast or Southern California, we can post the other income limits for areas like maybe you're in Sacramento or maybe you're in San Jose. Well, those are different income limits, but at the end of the day, CalHFA income limits are based upon 150% of the median income. Again, a great resource to help you on this path towards homeownership. All right, we're getting towards the tail end of class, but I want to get a chance to walk through the buying process with you. I think that's really important to understand, like, what comes next. So maybe after attending tonight's class, your interest is piqued a little bit more about home ownership. Like, you need to understand as a future buyer, where do I go from here? Well, we would encourage you to get connected with us for a consultation. That's a 30-minute session I do one-on-one with every client we work with on our team. And we're going to design a plan for you, a comprehensive plan for home ownership. Now, the output of that session is going to be pre-approved. And a pre-approval essentially creates like the framework of all your financing and allows you to basically start shopping for homes and making offers on homes. Now, usually that pre-approval is good for 60 days, but it can be always recertified at any time. So many of our buyers have several months that it takes for the home ownership phase of the process. And that's the second step in the process. So, it could take more than several months. It could take, 2 or 3 years to find the right home. But at the end of the day, that pre-approval can be updated as we kind of continue to go through our home search. And the house hunting can start online. It can be in person, but it more than likely will start online. And then we always encourage clients to always connect with a realtor that can be a resource for them in negotiations, property search, inspections, things like that are really important. But step 2 is house hunting, finding the right place for yourself, connecting with a realtor that can support you on your journey. Now, there were some changes in commission schedules for realtors probably about 7 weeks ago, maybe 8 weeks ago, which changed the way in which realtors are compensated. So prior to the National Association of Realtors settlement, it was kind of always assumed that sellers would pay the commissions of realtors, but that has since changed. Usually buyers will have an agreement with the realtor in terms of how that realtor will be compensated. We're not, of course, experts in that field, but we would encourage you when you do decide to connect with a realtor, have that discussion with them about how that agreement might work and timeframes of the agreement. Now, as we kind of continue down the path, let's say I find the right home, right? And I make an offer on a house. And by the way, it doesn't usually happen on the first time, but let's say it does in this case. The seller accepts my offer. So that's great news, right? That's kind of half the battle in the process, which is getting an accepted offer. On the day of the accepted offer, you're going to get a call from us saying congratulations. And we're going to kind of talk through high level, what's the contract agreement look like. We're also going to talk a little bit about timelines, and then we're going to get connected with you for a follow-up video session. And in that session, we're going to get a chance to dive into more about what's our monthly payment look like, what's, again, the timelines and milestones that I should expect, and what's my total out-of-pocket going to look like for my home financing. We usually try to do that within the first couple of days of the accepted offer. Now, from the accepted offer timeframe to when I get my keys to my house, which is the most important date, it usually takes on average about 30 days. But it can be as quick as 14 days. We actually have a quick close program that we offer, but as a general rule of thumb, it's usually 30 days. Now, at step 3, now things start to get in motion. You as a buyer generally are expected to make an earnest money deposit on your home, which is 1% to 2% of your total sales price. It's basically a good faith investment that you're putting into the transaction, showing the seller that you have a vested interest in making this transaction happen. Now, that deposit, I will say, is protected by contingencies, which essentially protect the deposit, but allows you to do your investigative work, like getting the house appraised. We want to make sure the home is worth what you're buying it for, getting your inspections done on your house, and then getting your loan approved. Usually that contingency period is from day 1 to day 17 within a real estate contract. All right, I'm going to take a quick pause because I know I'm getting a bunch of questions and I don't want to get lost in these questions. So let me just make sure that, let me just answer one of these. And we're going to go a little bit off topic here. So the question is, so if your combined income is above the limit, but your individual income is below, you can still just apply with your single income on the CalHFA loan. Yes, that is correct. So if you have an income limit of 194 because you're going to buy in West Hollywood, if I use just my income of 150 and I'm the only one applying, not my spouse, then that 150 is only included in the income calculation. So that is correct. And then another question was, are there any restrictions on whether the pre-approval consultation can happen virtually, or does it have to, or does it not matter if you live outside of California? Yeah, I guess that's an important point. So all of our consultations are all virtually. So we work with clients in Washington, D.C., Texas, Missouri, all over the country, all done virtually. So yeah, most of what we do is not having in-person appointments. It's all usually virtually. But we do have brick and mortar offices in markets that we support too. And then last Q&A, and then that came in the Q&A is the earnest money deposit part of closing costs? Great question. So earnest money is not part of closing costs, but it can go towards closing costs. So when we think about our overall cash contribution for homeownership, it's going to be around down payment. It's going to be prepaid items, which will be inclusive of the daily interest on your new loan, first year of homeowners insurance, and setting up what we call as an escrow impound account. But that earnest money deposit goes as a credit towards the out-of-pocket expense. So if I have to contribute, let's say, $15,000, right, towards my total out-of-pocket, but I've made a $3,000 earnest money deposit, theoretically, that $3,000 will count as a credit. So then I would just only owe $12,000 at the end of the transaction. All right, great question. As we kind of move through the process, step 4 is going to be processing and underwriting of the loan. That's going to be more of the administrative task of the financing. Our team will be verifying employment, assets. We probably will have your rate locked in by that time. By the way, interest rates can vary until you have an accepted offer on a property. Once you have an accepted offer, then we can lock in the interest rate. But as we talked a little about earlier about interest rates, they do change often. And so there's some strategy on making sure we can hopefully lock in the lowest interest rate option for you. Step 5 is going to be the loan approval. And that also takes us right about to the contingency period. A loan approval means an underwriter has reviewed your income, your assets, your credit, make sure everything kind of matches to the product that we're offering. By that time, you've also probably had your inspections done, your appraisals completed. And it gets us to the end of the contingency period. So if you feel comfortable with all the investigative work you've done, then you can sign off on that contingency for your home purchase. But it does tell the seller that you've done all your kind of your research and you do feel comfortable moving to the very end of the process. To that end, we're going to issue a final closing disclosure to you at step 5. And it gives you a 3-day cooling off period before we get to the very final milestone, which is the favorite part for most of our buyers, which is the closing of the loan, because that means we're at the finish line. And that's when we sign final loan documents in person with the public notary. At that time, we also deliver our final amount of funds needed for the home purchase. As a lender, we're also going to wire in the final funds for your home financing. Those funds get all reconciled by the title and escrow team, and then documents get recorded with the county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the new loan that you're taking out to secure your property. And after everything gets confirmed as recorded with whatever county recorder that you're purchasing in, then you become the official owner of the home. And that's one of our most exciting days. We get a chance to celebrate with you on this huge accomplishment because now you've achieved home ownership, which is an amazing thing to do, right? And so, we want to be there right there to celebrate that along with you. Now, it doesn't come with a little bit of stress and anxiety as we move through the process, but we truly really look at the human touch of this business. We want to make sure that we're here every step of the way to help guide and support you during the home buying journey. Now, if you're thinking about moving forward in the process, we'd love to be able to get connected with you for a consultation. Again, that's a one-on-one that you do with me. And again, that's virtually, as we talked about earlier. It allows us to design a home buying program for you. Now, we don't have to run out and buy a house this year, maybe even not in the next 2 or 3 months, but it gives you the framework for home buying and allows you to set some goals and objectives towards home ownership. It's a 3-step process. It starts with an online application, a soft credit check, so you don't have to worry about your score being impacted. You upload proof of income and assets, and then you use our scheduling system that you can see here to schedule that video consultation. And I get a chance to do that throughout the day. It's really enjoyable to get a chance to kind of screen share different options for clients and kind of inform them on what their options look like. Now, if you do have some questions after tonight's class and maybe you just want to run a scenario by us, you can get scheduled for an introductory call. You can use our scheduling system to book that. And that's something where you just get a chance to hop on a call for like 10 to 15 minutes. Here's what the consultation looks like. Again, it is a free service. We're talking through that conversation about where do I want to buy? What's my budget look like? We're going to kind of spend some time looking at credit and assistance resources. Just kind of get a comprehensive design put together for your home buying plan. All right. So in our process, we do leverage technology, right? And one of those resources is through mobile. So you can start the process through mobile. You can track progress of your loan through mobile. It's available for Android as well as Apple devices. It doesn't replace the human touch side of our business, but certainly we leverage resources and we want to stay connected with our clients through the process, whether it's text, call, whether it's email, it's always keeping you top of mind on what's going on in the process of your loan. Now, beyond our wonderful UCSB alumni partnership, we have other partnerships across the country. We're up to like 14 or 15 different alumni partnerships that we teach very similar classes like this. But if you do have friends, family, or coworkers that might enjoy some of this content, we'd encourage them to check out some of the classes that are upcoming. We'll have a full slate of classes, up to 60 to 70 classes in 2025. They can find the location and the times of those classes by visiting us at mortgageeducate.com. Here's all my contact information as we're getting to the end of class. So if you do have questions and just want to reach out to me, feel free to give me a call or send me a text or email, whatever's good for you. And we do try to create good content for our socials. So not only going to see this video up on our YouTube channel, but we try to put posts up on our Instagram. They're going to really benefit you in this journey towards homeownership, but also we like to celebrate homeownership and all the accomplishments of our buyers. So more often than not, you'll see some wonderful testimonials from clients right in your local community. All right. Well, that takes us to the top of the hour. I got questions coming in. And so I'm going to take a few of those. I know if some of you that need to drop, totally fine. But we'll definitely get the recorded version out to you. So first question is, where do I go to block the initial call time? So scheduling system, which you can see on screen right here. I think Ken can drop that in the chat for you if you want to do that. But we'll also have it out in the email tomorrow. So we'll definitely get you that information. I thought I saw a question that came in. Okay. Okay, all right, appreciate that. Okay, and I think we just put that link in there. Um, okay, we answered that. All right, perfect. Um, Good question coming in here, which is if you have to make a big purchase, say a car, when would be the ideal, well, when would that be ideal before making the purchase of a home? So, I think if depending on how important that upcoming big purchase is, I would, if you really need a car and you have to because you have to commute to work or whatever, obviously you got to take care of that. But if home ownership is in your plan for the next 6 to 12 months, I would really encourage you not to make the big purchase. And because that new purchase can do a couple things. One is it adds maybe a new expense to the equation for you, but could lower your credit score, especially if you're financing a vehicle. So we would encourage you to talk with us first before making those purchases. Some of our clients, it's not a big deal. You can absorb the expense and they can still maintain their home buying plan, but we'd encourage you to talk with us first. If you're in the escrow process, so steps 3 to 6 that we talked about earlier, definitely do not want any big purchases being made because that could certainly change the kind of the setup of the financing. All right. I think we touched on everything. Okay. All right. I got it. Thank you for that too. I appreciate the thank you in the chat. All right. I appreciate everyone's time this evening. We're a couple minutes over our time, but I thank you for staying around with us. Hopefully you enjoyed this tonight's content. Again, feel free to share this with friends, family, or coworkers that could also benefit in these resources. Have a wonderful evening. I look forward to talking to you soon. Have a good night.